Welcome back to the Deep Dive, where we take a heavy stack of complex industry research and, well, give you the high-value shortcut straight to the knowledge you need. Today, we are strapping in for a fascinating dive into the energy sector. We're focusing on a company you probably know as Schlumberger or now just SLB. It's a true global behemoth in oilfield services. And our mission today, it's really to figure out exactly how a leader this big navigates the, frankly, incredibly volatile energy market we're seeing in the mid-2020s.
That's right. And for this dive, we're leaning on a detailed research report from CompuScope. We've also got fresh insights pulled directly from SLB's recent Q2 2025 earnings call transcript. So the plan is to quickly pull out the core structure, the key competitive edges, those aggressive growth drivers, and maybe most importantly, the big risks they face trying to execute their strategy.
Okay, sounds good. Let's unpack this business structure first. When we talk about SLB, we mean the company providing tech and services across the entire oil and gas lifecycle, right? Exploration, drilling, production, the works.
Exactly. And they organize this huge scope into four main lines of business, or LOBs as they call them.
Four main ones, okay.
Yeah, and these LOBs, they're really designed to cover every possible stage of a well's life.
Yeah.
It's a key part of their whole diversification strategy.
Right. So the first two are kind of about finding and building things. You've got reservoir performance. That's all the deep underground stuff. Subsurface evaluation, mapping, trying to maximize what's down there.
Precisely. Think specialized tech, like fracking and stimulation, or using their own wireline reservoir technology to really get a handle on a field's potential.
And that flows, I guess, directly into the second LOB, well, construction. This is more the hardware and the know-how needed to actually, drill the hole efficiently.
Right. And they're a recognized leader here. Things like directional drilling services, rotary steering tech.
Yeah.
It's all about putting the well exactly where it needs to be and keeping costs down.
Okay, so find the resource, drill the hole.
Yeah.
Then comes the third one, production systems. This must be about keeping the oil or gas flowing once the well's actually finished.
Yeah, and this is, you could argue, the most critical segment for them right now. It covers everything from artificial lift systems, completions, even midstream equipment.
And production systems, that's where the really big strategic shift is happening now, isn't it, with ChampionX?
Exactly. This is where that huge ChampionX acquisition slots in. It massively boosts their strength in things like production chemicals and enhances their artificial lift tech. It really changes their whole revenue mix, which we should definitely circle back to.
Definitely. Okay, and that brings us to the fourth pillar, and maybe their most defensible one, digital and integration.
Oh, absolutely. They are the undisputed leader here. It's all about data-driven solutions, operational efficiency. The two big platforms you hear about are Delphi, that's their cloud-based SaaS system, huge user base, over 700-800 users now.
Wow.
And Lumi, which brings in AI for real-time analytics, faster, better decisions on the ground.
That's huge, but we can't forget that sort of fifth pillar, can we? The new energy side.
Good point. Yeah, you connect this to the bigger picture, the whole global energy transition thing. SLB is definitely making strategic investments here. They're heavily involved in carbon capture, utilization, and storage, CCUS. They even have specific platforms for it, SLB Capture and Sequestry.
So this new energy focus, is it just them hedging their bets, or is it like a real strategic pillar for the future?
It feels like both, but leaning more towards strategic now. I mean, the fact they're developing dedicated platforms like Capture and Sequestry, and they're actually participating in major projects like that Longship CCS project up in Norway.
Right.
It shows it's not just, window dressing. They're using their core subsurface expertise, the stuff they learned looking for oil and applying it to CO2 storage and geothermal. It's their way of keeping those high-margin services relevant as the world tries to decarbonize.
That's a remarkably complete portfolio they've built. Okay, let's switch gears. Competition. CompuScope calls their advantage moderate. Now, given that digital-led and global reach you mentioned, shouldn't it be stronger? Like, where are they maybe falling a bit short compared to, say, Halliburton?
Yeah, that's a fair question. Moderate sounds a bit weak, maybe, but it's because the whole oilfield services sector is just inherently cyclical. It's driven by commodity prices. However, CompuScope does clarify that this advantage is also highly defensible. And that's built on two really big strengths that create a kind of moat around their business.
Okay, what are those?
First, that technological leadership we talked about. The Delphi and Lumi platforms, they create really significant switching costs. Think about big companies relying on software like Salesforce or SAP.
Yeah, once you're in, you're in.
Exactly. Once your whole massive, complex, multi-million-dollar operation runs on their software, the cost and just the sheer pain of switching is immense.
And the numbers seem to back that up. That 95% retention ratio for their digital solutions is pretty startling. That's sticky revenue competitors really struggle to chip away at.
Precisely. And the second major strength is their geographical diversification. Over 75% of SLB's revenue comes from outside North America.
Right.
And that gives them powerful insulation from what they call short cycle volatility.
Okay. For listeners, when we say short cycle volatility, are we mostly talking about the fast up and down nature of North American shale drilling?
Absolutely. Those North American shale producers, they can turn rigs on and off almost instantly based on daily oil price moves. It's incredibly reactive. SLB strategically has focused much more on stable, long-term international contracts. Think offshore, deep water, the Middle East. These are projects measured in years, not months, so it buffers them against those sudden shocks.
Makes sense. So let's break down that peer comparison then. How do they really stack up against the other big players, especially considering their weaknesses?
Okay, well, if you look at Halliburton, HAL absolutely dominates that North American short cycle, the shale market, no question.
Right.
But because SLB has that huge global footprint and that digital lead, SLB holds a much more defensible position internationally.
Right.
HAL just doesn't quite have the same digital platform capability globally.
Okay. What about Baker Hughes? BKR.
BKR is interesting. They're actually much more aggressive on the energy transition front, hydrogen, LNG, CCUS, maybe even more so than SLB right now. But the trade-off is BKR seems to lack SLB's overall digital competitiveness, and they tend to struggle with weaker operating margins in their core oilfield services business compared to SLB.
So the bottom line seems to be that SLB holds the most kind of balanced and robust competitive advantage, using digital and that global reach as its main shield against the market swings.
That seems to be the consensus, yeah. The really broad service offering, from figuring out what's underground all the way to managing production, just gives them a defensive position that more specialized competitors can't easily match.
Okay, now this is where it gets really interesting for me. The growth strategy. If the overall market is, maybe stabilizing or even declining slightly, how are they actually planning to keep growing? Seems like they're relying on 4 key pillars here.
That's right. Growth in a potentially flat market is the challenge.
So pillar 1 seems straightforward, international and offshore expansion, just doubling down on those stable long-term projects, Middle East, Latin America, like Brazil's Santos Basin, deep water off Africa.
Yep, exactly. Playing to their strength in stable, long-cycle markets.
Pillar 2 is digital growth. That's clearly their high-margin engine. They're expecting double-digit CAGR compound annual growth rate for Delphi and Lumi. That's scalable revenue that should easily outpace the traditional service side.
And this is critical, right? Because digital growth doesn't need the same massive capital investment as, say, building a new drill ship or a factory. It's much more scalable.
Right.
And that ties into the third pillar, the ChampionX integration. This really reinforces that shift away from volatile capital spending cycles.
Okay, tell us more about that shift. They're targeting a really ambitious $400 million in synergies by 2028 by bringing ChampionX into the fold. How does adding ChampionX fundamentally change their business model?
It's a profound shift. It's moving focus from CapEx, capital expenditure, towards OpEx, operational expenditure, traditional oil field services. They rely heavily on CapEx. New wells being drilled, new big projects starting up. That's super cyclical.
Yeah, it depends heavily on oil prices.
Totally. ChampionX specializes more in production recovery, chemicals. These are services tied to OpEx. Think of it like this. A company might delay a massive new drilling project CapEx if oil prices crash, but they almost never delay the essential maintenance and optimization on an existing well that's already making the money. That's OpEx.
Ah, okay. That makes sense.
So adding ChampionX gives them these resilient, less cyclical, OpEx-driven revenue streams. It's tied to getting more out of wells that are already producing. And CompuScope estimates that market optimizing existing production will actually outpace global CapEx growth this decade.
That's smart. Making themselves more resilient by betting on software and maintenance, that's always a good move in a cyclical industry. And the final growth pillar, that's the new energy solutions again, right? Expanding CCUS, getting involved directly in those big long-term projects driven by regulations.
Exactly. It's all about diversification into more stable, predictable areas. But, every big strategy, no matter how clever, comes with pretty significant risks.
Right. Let's look at those operational dangers. What are the main execution risks facing SLB right now?
Well, number one, it always comes back to commodity price dependency. E&P spending is just super sensitive to oil and gas prices. If Brent crude, say, drops below $60 a barrel for a sustained period, those long-term international projects could get deferred or delayed. That puts their big backlog at risk.
Okay, that's the big external one. What about internal risks?
Number two is definitely integration risks with ChampionX. They absolutely must hit that $400 million synergy target. The breakdown is roughly 75% from cost savings, 25% from finding new revenue opportunities together.
That sounds ambitious. $400 million.
It is. And if they miss those targets, especially the milestones along the way, there could be significant value erosion. The market will punish them for that.
What's the track record usually like for these kinds of massive integrations? Is it often tricky?
Oh, notoriously tricky. Yeah. Achieving synergy targets is often where big deals stumble. Now, the fact that 75% is focused on cost savings, that suggests they might have a clearer path, things they can directly control and cut. But that 25% revenue synergy, that's always harder to guarantee.
When do we get a sense if they're on track?
They've said they expect to hit about 50% of that total $400 million target by 2026. So if they miss that 2026 milestone, yeah, the market's likely to lose confidence pretty quickly in the whole value proposition of the deal.
Okay. And the final risk?
Geopolitical dependency. With over 75% of revenue coming from international markets, they are just inherently exposed to instability. Crucial, often sensitive regions like the Middle East, parts of Latin America, political shifts there can have a big impact.
So, putting it all together, is SLB actually at higher risk than its peers because of all this?
Well, based on the detailed analysis, the answer seems to be generally no. Because of that sheer diversity we talked about, SLB is actually positioned for relatively lower execution risk compared to some peers.
How so?
Well, contrast their situation with, say, Halliburton, which is super exposed to that highly cyclical North American market. Or look at a company like TechnipFMC, which relies heavily on securing huge, specific subsea project orders, very lumpy, very concentrated risk. SLB's broad footprint, while exposing them to geopolitics, generally provides more resilience overall.
Okay, now let's bring this right up to date. Let's look at the immediate past and the near future using that Q2 2025 earnings call. How did SLB actually perform recently, given all these strategies and risks?
They delivered pretty solid Q2 results. Not explosive, maybe, but steady. Revenue came in at $8.5 billion. And they managed a slight expansion in adjusted EBITDA margin, up to 24%. This basically reflected good, broad operating execution. They navigated some headwinds sequentially in certain markets. There were some temporary project slowdowns in Saudi Arabia, for example, but overall pretty steady.
And the big news from the quarter was obviously the ChampionX deal closing.
Absolutely. That officially closed in July 2025. So the consolidation of ChampionX's results starts August 1st, 2025. This means we'll immediately start seeing that OpEx-driven revenue stream boosting the production systems division.
Okay. So that impact starts right away in Q3.
Well, partially in Q3, fully in Q4. Yeah. And remember, ChampionX's own digital activities, they actually roll straight into SLB's main digital segment, not production systems.
Got it. And what about the outlook? What are they saying for the second half of 2025, especially now with ChampionX in the mix?
Yeah, the H2 outlook is crucial, and it's a little complex with all the moving parts. They guided for second half revenue somewhere between $18.2 billion and $18.8 billion. Now, when you adjust for assets they sold, like their Palliser business, and you factor in only a partial contribution from ChampionX in Q3, this basically represents flat to maybe low single-digit growth compared to the first half of the year.
Flat to low single digits, okay.
Yeah, and a really key takeaway here is that the revenue profile is expected to be distinctly backloaded into the fourth quarter.
Meaning most of the growth hits late in the year.
Exactly. Primarily because Q4 will have the full quarterly contribution from ChampionX, plus you typically see a seasonal rush in high-margin digital software sales right before year-end. Yeah. Companies try to use up their budgets. That tends to push Q4 figures up.
Makes sense. What about those all-important margins? Are the high digital margins getting dragged down by integration costs or anything?
Interestingly, no. They expect H2 adjusted EBITDA margins to be essentially flat sequentially compared to Q2, even with ChampionX added in.
Flat? Why flat if ChampionX is supposed to be good margin business?
Good question. The flatness is specifically because they're absorbing an anticipated 20 to 40 basis point negative impact from tariffs. They called that out specifically. Without that tariff drag, margins actually would have expanded slightly, so it shows the underlying core business mix is holding up pretty well.
Okay. And we also saw some of that regional volatility playing out in Q2, didn't we? Underscoring the value of that international buffer you mentioned.
Absolutely. International markets actually grew modestly, about 2%, driven by strong work in the Middle East, Asia, North Africa. But North America, well, it proved its usual volatility, declined sequentially.
Why is that?
Mostly the seasonal Canadian spring breakup, where activity slows right down, plus they didn't repeat some large exploration data sales they had in the previous quarter. Just normal fluctuations for that market.
And one other big change internally that really signals their commitment to digital. They're changing how they report earnings, right?
Yes, that's a significant move. Starting in Q3, SLB will report the results of its digital business as a separate fifth segment.
A whole new segment just for digital.
Yep. They're doing it to give much greater visibility into that part of the business, mainly because it's growing so fast, double digits, and it's incredibly profitable. Just to give you an idea, in Q2, the digital and integration margins soared to nearly 33%.
Wow, 33%.
Yeah, that's way higher than their traditional service divisions. So that reporting change really highlights just how crucial that digital pillar is to the whole company's story and valuation now.
Okay, so bringing it all together, if a listener wants to really monitor SLB's success going forward, what are the absolute keys they should be tracking over, say, the next 18 months?
Right, boiling it down, there are probably 5 factors of really high importance you need to watch. Because they directly impact SLB's ability to actually execute this strategy. First, always watch global oil and gas demand and prices. SLB's fate is still intrinsically linked to overall E&P spending. Keep an eye on OPEC plus decisions, demand recovery, especially in places like China.
Okay, number 1, oil price.
Number 2, execution of the ChampionX integration. You've got to track their progress towards hitting that full $400 million synergy target by 2028. Critically, watch if they hit that 50% milestone they targeted by 2026.
Right, the synergy delivery.
Third, adoption of digital and AI solutions. Monitor those customer adoption rates for Delphi and Lumi, especially in international markets. That's the engine for the high-margin, sustainable growth that really sets them apart from peers.
Digital uptake, got it.
Fourth, offshore and deepwater project approvals. These are the FID's final investment decisions. The pace of new, big project approvals, particularly in those large, deepwater basins like Latin America and West Africa, that's the lifeblood of their long-term backlog. It's crucial for revenue stability down the line.
So are the big projects getting sanctioned?
Exactly. And finally, number 5. Keep an eye on the macroeconomic environment and geopolitical risks. Remember, 75% plus international exposure makes them vulnerable. Political instability, especially if conflict disrupts production or key shipping lanes in the regions they rely on, that's a constant background risk.
Okay, so to kind of synthesize this whole deep dive, SLB is really leaning on its established tech and digital leadership, that wide geographical diversification, and now this newly bolstered, more resilient production systems division thanks to ChampionX. They're trying to navigate a market where overall traditional global upstream spending might actually be declining slightly in 2025, and they're managing risk by consciously shifting focus away from the most volatile CapEx cycles towards higher margin digital and that more stable OpEx-driven production recovery work.
Exactly. Which leads to, I think, an important question for the long term, something for you listeners to really consider. Given that the total traditional upstream market might be shrinking slightly, how effectively can SLB's high-margin, tech-focused strategy truly continue to insulate its growth? And maybe more broadly, if this kind of balanced, digitally driven model relying heavily on software and optimizing existing wells proves highly successful in delivering stable revenue even in a tough market, could this become the mandatory new standard for the entire oilfield services sector going forward? Something to think about.
This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.